Hi guys, Sam here, and today we're talking all things development finance. Yes, more specifically, 7 things about development finance that you've always wondered but were afraid to ask. So if you're looking to take out development finance, you have done in the past but maybe you've got it wrong, stick around because on this video I'm going to be going through 7 things that you will want to know about development finance but maybe you've been afraid to ask. Property is about patience. Hi guys, welcome back, and as I was saying before, today we are talking development finance, and specifically I've got 7 things to run through with you today, which are basically questions that I get asked quite a lot about development finance, and I thought I would compile them all together, stick them in a video for all of you to enjoy. So as I said, got 7 things to run through with you today, so let's kick it off with number 1. Number 1 is, what is the difference between a bridge and development finance? Really good question, especially if you're pretty new to this type of finance. It can be quite a strange idea, the difference between maybe a bridging loan or a development finance loan. Now, I actually say that development finance is kind of within the bridging family. It falls under the bridging umbrella, shall we say. But the main difference really is that with a bridge, they're both short-term finance options, so that's the main thing. But the difference really is that a bridge is used primarily as an acquisition finance tool. So we will take out a certain percentage, very similar to a mortgage, of the purchase price, and that will be our bridge loan. It's as simple as that. We're buying a property for 100k, we borrow a bridge of 75k, done and dusted. Development finance takes it one step further. If you've got a heavy refurbishment to be doing, maybe you're doing a huge renovation, or it could be anything down to, from a flip to a ground up development, there's going to be costs involved in doing that. And so the development finance encompasses the purchase, so an amount of money that will go towards the purchase, similar to a bridge, and covering up to, in some instances, 100% of the cost of that development. So that is the basic difference between the two. A bridge you use to purchase the property with, development finance you use to purchase the property with, or purchase the project with, and cover the cost of your the work as well. Now that brings me quite nicely on to point number 2, which is, what is loan to GDV? This is something that I'm asked quite a lot because you'll see this on a lot of documentation with development finance, the words LTGDV. Now, most people are used to the term loan to value, LTV, because whether taking out a bridge or a mortgage, usually the amount that you can borrow is done as a percentage of the purchase price or the value of the property. Now, when it comes to development finance, the maximum loan is actually worked out on the GDV. And what does GDV mean? GDV means gross development value. It means what the value of the property is going to be once the development, whether it's, as I said, a big ground up, huge site is going to be worth, or the property that you're renovating, depending on what end of the spectrum you're at. And the loan is worked out as a percentage of this. So typically we look at somewhere between 50 and 60% of this amount. So if the GDV, the gross development value of a site, is going to be £1 million, then the maximum loan, if it was 60%, would be 600,000 as an example. Okay. This is split up though. So it's got to cover 2 aspects, obviously, as we discovered in the first part to this video, which was the difference between bridging and development finance. There's a purchase aspect, there is a development finance or a development costs aspect. So as I've said before, we can cover up to 100% of the development aspects of the costs of the work. Where does that leave us when it comes to the purchase price? Now, most development finance lenders will cap the amount that you can borrow day one on the purchase price at 70% of this amount. So if you can borrow up to 70% of the purchase price as part of the overall loan. Whatever remains of that percentage of the GDV can go towards the costs of the work. Now, as I said before, if this means that actually the amount that's outstanding can cover you all the way up to 100% of this amount, then there are a number of lenders out there that will allow you to do that. Some will limit that again, so it might be 90% loan to costs, 80% loan to costs, something like this. These are the kind of terminology that you're going to hear. But effectively, the overall loan, which is the loan to GDV, loan to gross development value, will cover two aspects, both of which may have limitations. The purchase aspect may have 70% loan to value. The development aspect may have a loan to costs limitation, but there are lenders out there that will cover the whole of the cost of the works, which is great. Now, this brings me again on to point number 3, which is how are these development finance payments made, or how do the drawdowns occur? Now, typically what we'll do is when you purchase the property, you will get given a certain amount of money towards the purchase, very similar to taking out a mortgage or a bridging loan. Then what happens is you will be expected to pay the first amount towards the cost of the works. And at various different points throughout the build schedule, which are worked out during the application process, and I'll come on to that in a sec, the quantity surveyor will come around, meet yourself and the project manager or the contractor, and tick a box to say that you've reached a certain point that's been predetermined. If that happens, the lender will then allow you to draw down an amount of money that will essentially pay back that first amount. So what happens is you pay out, you get paid back. You pay out, you get paid back. You pay out, you get paid back. And this can happen 2, 3, 4 times throughout the course of a development project. Now, these stage payments are actually worked out during the application process, because what will happen is when we actually apply, the lender will send out a quantity surveyor to the site. And as I said, they would meet yourself, they'd meet the contractor, they'd meet the project manager. They go through the schedule of works and they'll work out between them when these stage payments should be made. You only actually pay interest on the money once it's been drawn down. So that also becomes a factor in how many of these drawdowns will occur throughout the build. So these are all determined then. And as I said, each individual stage payment, in order for that to be drawn down, for a box to be ticked so that it can actually be drawn down, the quantity surveyor will come out again and just check that the project is going as planned, basically. So that is point number 3. Now, point number 4 is all to do with documentation. I get asked this a lot. What documents do I need in order to apply for a development finance loan? And these can be broken up into 4 categories, basically. Number 1 is the development appraisal. This is essentially an overview of the entire project. It will include things like the purchase price, the cost of the works, the fees, every sort of aspect of the costs involved to acquire the property and do the building work. And it will also have an information on how much the project is going to be worth, what the GDV is at the end, and basically kind of show a net profit of that if you're selling the property, for example. So that is the development appraisal. It's a really, really basic kind of spreadsheet, and most developers should get very, very used to seeing what these are, because this is actually the way that you can appraise your potential projects to see whether they're worthwhile, to be quite honest with you. So certainly we're going to need that very, very early on. Secondly is your property CV. Lenders want to see that you've got experience, and we're going to come on to that in the next point, but a property CV, details of what you've done in the past, is going to be what's needed. But as I said, I'm going to come on to that in a second, a bit more detail. The third is the schedule of works. This is something that you should have from your contractor, should really ideally be on the headed paper to show that it's actually from the contractor that you're going to use, and it will have a breakdown, sometimes day by day, sometimes week by week, sometimes month by month, depending on how big the project is, of all of the works that need to be achieved and the costs to do that, giving us a nice sort of sum at the end to show us exactly what the total cost of the build is going to be. So it's effectively taking that little aspect from the development appraisal and opening up a little bit more and giving a lot more detail. The last thing, relatively standard, is an assets and liability statement. Lenders want to know what your personal financial and wealth situation actually is, because this gives them confidence potentially that if you've got a bit of a base in the background of wealth, it's a bit less risky to lend you the money effectively. Then you've actually got something in the background that if something goes wrong can help the overall situation. So having an assets and liabilities statement is pretty much a prerequisite, and all of my clients that are really, really good developers just have this ready and waiting whenever I need it. So they are the 4 sort of main documents that you're going to need when looking for development finance, when applying for development finance. But I did mention about the CV, and this comes up under point number 5, which is all to do with experience. Now, first and foremost, let's talk about that CV. Your property CV should include everything that you've done in property previously, or shall I say everything that's relevant to this particular project. I personally think that everyone should just keep an overall CV, and if you need to, if you're really, really experienced, you just want to create a smaller one for a particular project, you can do. But we basically kind of split the experience into 2 different sections, and that is sector experience and principal developer experience, and I'll explain what the difference between those is. Now, principal developer experience is actual experience of you being the developer. So if you've bought property, you've refurbished it and you've sold it, that's that's your experience. You've done that, you've managed that entire project, and you are the principal developer. If you've bought a plot of land, you've got planning permission, you've built 45 houses on it, you are the principal developer. Even if it's the company that you own, you're the principal developer. That counts, the most in terms of towards experience from the lender's point of view. Sector experience is something that we can use to back ourselves if we don't have a lot of that principal developer experience. So me, for example, as a broker, I've worked on a number of quite large projects, and so that for me could potentially go towards sector experience. If you're a quantity surveyor and you've worked on projects, that can be your sector experience. If you're a builder, if you're a contractor and you've worked and priced up and finished off big projects, that can be sector experience. So we can put all of that together. Now, how does that help you? When first starting out and you don't have a lot of experience, your pool of lenders that's available to you is a little bit narrower than it will be later on. Lenders like to see that you've got some experience. They're not taking a punt then. Their risk is relatively high if you don't have any experience, and so the pool of lenders is much smaller. It will also mean that things like the costs and the interest rates are likely to be a bit higher as well, because that's basically how the lenders are pricing their risk accordingly. The more experience you get, the better terms, the more options you've got for lenders. So it's why experience is so important. It's why it's so important to keep a record of it through a CV. Point number 6 then is costs. Now, I get asked this quite a lot to do with just finance in general, and maybe this will be another video where I can think of every single tiny little cost that I can think of. If that would be relevant, drop me a comment below and let me know, and I can put together a video on that. Although it sounds quite boring, but probably quite important from an educational point of view. But there's sort of, I'd say, 3 main costs when it comes to bridging development finance, and that is number 1, lender's fees. Now, typically you're looking 2% of the loan amount. This would usually be deducted from the loan, so you're not going to be paying it up front, but it will be deducted from the loan. Usually it's typically around the 2% mark. Some lenders will also incorporate an exit fee. This is usually about 1 to 2% as well, but hopefully we can get rid of that, and we're just looking at the entrance fee or the application fees, but this would be around the sort of 2% mark. Solicitors fees, just like bridging, you would be expected to not only pay for your own but contribute either partly or wholly to the lender's solicitors costs as well. So this is something that you need to factor in. It's not something that we're going to know up front before we start doing research and actually getting terms from lenders, but a lot of them will be able to come back and give us an indication of what these costs are going to be on their initial heads of terms. They prepare sort of credit back terms to say, yes, we would do this particular deal, and it's on these terms. And usually the costs of the lender's legals will be included in that. Obviously, the costs for your own legals are your own business, and it's something that you'll negotiate with your solicitor. On that point, make sure that you always have a experienced commercial solicitor when doing taking out development finance it is 100% worth it. I can guarantee you that. But that cost is obviously down to you to negotiate. But you know, paying a little bit more for a good one is well worth it, I would say. And the last is the valuation. Now, for mortgage purposes, a lot of the time the valuations are relatively cheap. You know, we're talking a few hundred max. When it comes to development finance, what we're actually looking for here is not a valuation for mortgage purposes. We're sending out usually a quantity surveyor, and they're doing what we call a red book valuation. It's a much larger document, much thicker than your standard little valuation. It's much bigger than that, and it goes into a lot more detail about the end value, you know, working in the costs and how that's going to affect things, you know, a lot more assessment of the market, all that kind of stuff. And it does take a little bit longer for them to do. So, you know, be patient with the valuers when they're doing this. But yeah, the cost of this is going to be more than your typical mortgage valuation, I'm afraid. There's no getting around it. It's what it's needed, and it's what the lender requires in order to get comfortable with the deal. So we've looked, you know, we've got the figures, we just need them confirmed, and we need a relatively reasonable amount of information and research to be done by the quantity surveyor in order to get that back. So that's the sort of the last of the three main ones. Now, if you are using a broker, the fourth would obviously be the broker fee. Typically, this is around the 1% to 2% mark. Most brokers will charge around that kind of amount. But the three, in terms of from a lender's point of view or from a deal point of view, are those three that I mentioned there: the valuation, the legals, and the lender's fees. Now, number 7 then is a big one. I get this all the time. Typically, it's not for like ground up developments, but it's more for like refurbishments and things like that. And that question is, why can't I use a regular mortgage for a development project? And the answer really is covered by sort of 3 main points. Number 1 is usually we'd be looking at sort of a buy-to-let mortgage, is what most people are thinking about when they're saying regular mortgage for these kind of projects. When you take out a buy-to-let mortgage, lenders are expecting you to rent that property out straight away, not buy somewhere and completely renovate the property and take 6 months to do so, and spend potentially tens of thousands, if not hundreds of thousands of pounds on a massive development project. That's not what these mortgages are for. They are for you to buy a property that you're going to rent out, buy to let. It's basically RONSIL. It's written on the package there. So that's sort of the first part. The other one is, if you're going to be doing substantial work to the property, effectively, whilst you're doing that, you are potentially lowering the value of the property. Buy-to-let lenders are not in for that. You know, they don't understand that principle. They're not looking at the gross development value. They're looking at, right, how much is it worth right now? Our loan is against that. Is it safe? And if you're going to be changing the property dramatically, that might actually have an impact negatively on the property value. So that's something to be wary of. And the other one sort of related to that is, if you're looking at doing ground up development, if you're going to buy a house, for example, knock it down and build 3 in its place, then there is going to be a point where there's no security. A mortgage lender needs a physical bricks and mortar piece of security in order to put a charge on that represents a good risk to their loan. And if you knock it down, there is no security, you're effectively in breach of your mortgage contract, and don't be surprised if that lender comes a knocking for their money back. So there we go. There are 3 main reasons why you cannot use a regular mortgage for your development finance project. And if you want me to do a bit of a wider look into that, both bridging, BRR, development finance, this kind of stuff, making comparisons to why you can't use a mortgage, drop me a comment in the below in the comments, and if I get enough interest, then maybe that's something I'll do in the coming weeks. But that was 7 things you never knew about, or you always wanted to know about development finance but were afraid to ask. And I'm just going to run those down here. I've got them written out, so let me just quickly read through them just to summarize. Number 1 was the difference between bridging and development finance. Number 2 was what is loan to GDV. Number 3 was what are stage payments. Number 4 was what documents do you need in order to make an application. 5 was all about experience. 6 was all about costs. And 7 was why can't I use a regular mortgage when it to instead of development finance. So I really hope that you found this very, very interesting and very, very helpful. It has been 20 minutes of quick fire information. Even I'm a little bit tired actually, because I've really hammered through this information quite quickly because I wanted to make it as as quick and succinct as possible. But I hope this has been interesting. I hope it's been helpful. If it has, do me a massive favor, subscribe to my channel, click the little bell, and you will be notified of all future videos. And don't forget, if anyone that you know is going to benefit from this, share it with them. There's a little share button below. Click on that, copy the link, send it to their Instagram DMs, text it to them, share it to your stories on Instagram, put it on your Facebook page, whatever you think, whatever is helpful in terms of getting this information to as many people as possible. Do help me out and share it about. So that's it. Have an awesome week, enjoy yourselves, and I will catch you on the next video.